our next speaker in our webinar, and that next speaker is R.Tronstad. Russell is Distinguished Outreach Professor and Extension Specialist in the Department of Agricultural and Resource Economics at the University of Arizona. Russ was born in western Montana and grew up on an operation that raised beef cows, dryland wheat, irrigated malting barley, and a few cows to milk by hand. After completing a BS in agricultural business and a master's degree in applied economics at Montana State University, he went to the University of Illinois, where he completed his PhD in agricultural marketing. In 1989, he joined the faculty in the Department of Agricultural Economics as an assistant specialist. While at the University of Arizona, his work has encompassed marketing and management topics that deal with livestock, dairy, alfalfa, cotton, and specialty crops. Thank you for being with us today, Russ, and please go ahead.
Thank you, Shannon. Thanks for that introduction. And as like Hernan said, if you have any questions or anything, probably the easiest way to get in touch with me would be via my email showing on the screen here, as well as any questions in the chat box. And I'm going to address the dairy margin coverage program here a little bit. And just to kind of summarize, I guess, a little bit, there's kind of three programs that dairy producers can actively participate in now. The dairy margin coverage program, which I'm going to talk about, and I guess, some things that are changed from what was in the prior margin protection program in the 2018 Farm Bill was you can participate in dairy margin coverage as well as the livestock gross margin, or you can participate in the dairy margin coverage and the dairy revenue protection program now. That's one thing that was removed. And the other thing is, like Hernan had mentioned, is it's based on the national price of the milk and feed costs. One of the things that is a little bit different from the dairy margin coverage than RMA's livestock gross margin is that premium quality alfalfa is included in the dairy margin coverage, but it very much acts the same in terms of it's kind of like a call option on the feed cost and put on the milk price, in the sense that it's trying to kind of put a ceiling on what you pay for the feed and a floor on what the milk price is, and put it in that range there. So there's similarities there, but there are differences as well. And Ryan, he's going to talk about the dairy revenue protection, which instead of a national price there is more of an area-based revenue product there, and it assures on quarterly revenue milk sales there. It assures against that. Just to get a background for the dairy margin coverage, there are fact sheets available from Farm Service Agency here, and it's kind of a concise way of summarizing. One thing that is covered through this Farm Service Agency is catastrophic coverage. That's the $4 margin, and that just requires the $100 administrative fee to be paid by the producer there every year. But there is also a Tier 1 and Tier 2, and we'll get into that. So things to select basically are your margin coverage level, and the maximum it can be is in terms of the margin is at $9.50 per hundredweight, and that's a Tier 1 and up to 5 million pounds there. The other thing is that you can lock in coverage here through 2023 on the margin here and get up to a 25% discount on your premium there if you lock in. Currently, as I believe that's still in place. And then the other thing here is you can select your range here in terms of production history that you want to insure for, from 5% up to 95%. That's widened a little bit. The dairy margin coverage is based on the production history. You can use what you had for your prior history or the highest annual production that you had from 2011, 12, or 13. But I guess the key thing is that just because you have high production this year, that doesn't change your production history. That's pretty much set there. Just to give a little bit in terms of some changes here from the dairy margin coverage to the prior margin protection program. Again, it increased the maximum coverage by $1.50 per hundredweight there. The cost is subsidized about at that same rate there. The other thing is that the dairy margin coverage, as I mentioned, does account for the dairy quality alfalfa hay now. And the biggest thing probably, or one of the bigger things here, was that you can now double dip in the sense that you can have dairy margin coverage as well as livestock gross margin or dairy revenue protection there. And before it was restricted to you had to do one or the other there. And again, you can increase the amount of your production history a little bit more, 5% more, and that's something you can add to your bottom line there. So how is the margin calculated? This is a formula here that's provided by NASS or Farm Service Agency and NASS, where basically the margin is the all milk price. And Hernan was mentioning there how Class 3 and Class 4 have a lot of influence on that. And then this also includes the corn price, the soybean meal price, as well as the premium alfalfa price. So just to kind of look historically at this here in terms of from 2014 to 18, you can see that if we were at the $9.50 per hundredweight in terms of the margin, where the orange bars are, there is places where there would be potentially a payment there to make up for that difference there in terms of the $9.50 per hundredweight. If you drop to 8, you can see the number of months there where you would have a payout, go about in half there from what they would be without. To just show you how the fluctuations in the relative value here, if you calculate, this is by the Dairy Markets and Policy Group in Wisconsin, very helpful graph here. But if you put that formula and imputed it back to the margin backwards through time, before dairy margin coverage was around, you can see when we had high corn prices here, from 2011 to 2014 in particular, that really jumped up the margin there, or the feed cost there, and you can see just the cost of the feed was well above that $12 per hundredweight there. So this just shows you that there is a lot of volatility in the market, and one of the reasons this product is around to help try to address some of the risk that you're faced as a producer out there with fluctuating feed costs and milk prices. So the idea is to cover on both ends with the margin there, the difference between the milk price and your feed cost. So just look here recently here for 2020 on the payout here for the months that are available. You can see over on the right there where the milk margin above feed costs here is less than $9.50. That's when payments are possible. So we reached that in March, and April went down, and then as they plummeted, as Hernan pointed out, in terms of kind of the lowest point on the prices in May, the milk margin above feed costs was only $5.37 per hundredweight, and then it jumped back up here in July, and then it's dipped down in September a bit to where there could be a little bit of a payment here for September here as well. And looking at it graphically here, this is also, you can see in a very helpful graph from the Dairy Markets and Policy Group. This yellow area here in the middle here is meant to be, about where 1/3 of the margin values typically would occur going backwards in time historically. But you can see this year, we've been anything but that, in the sense that the margin has been, way up to around 12 here, down around 5 is talking, and then back up again here, above 12, down, up and down, and forecasts here coming out. So I guess the key point here is that we might think, we have an idea where the market's going, but anything of recent has been that there's been a lot of risk here and volatility here in this margin. And the upper decile, basically about 10% of the time expect to be up there. Well, we've hit it, twice here this last year, and once here on the low side. In terms of looking at the schedule of premiums, as mentioned, here's the Tier 1 and the Tier 2. I guess the key thing here is with Tier 1, you can go all the way up to that $9.50 coverage weight here. That's just for the first 5 million pounds of production. So, if you take a dairy cow, say they were, the average is a little less than 24,000 pounds per year, but if you had that average 24,000 pounds per year, that would be enough to do about 208 cows, is 5 million pounds. So a lot of, dairies average, much larger than that, especially in the West. So, that's where the Tier 2 comes in. But a couple things to just note is that when you select the Tier 1, if you select $8 per hundredweight or less, you have to select the same coverage level for Tier 2. If you're above this, above the 850 or above, then you can select any coverage level you want here for Tier 2 when you select on the Tier 1 here. So that's just something to keep in mind there on this coverage. And that just kind of reemphasize that again, I guess it's an important point you want to make sure you get, is that if you elect to do that, $8 a hundredweight or less, then you must select that same coverage for Tier 1 or for Tier 2 that you have for Tier 1. So just keep that in mind. This is Farm Service Agency. They have a fairly helpful tool here as well to kind of see what's going on. The thing is, though, it's only updated, as you can see on this little box here. It's only updated at one point, kind of here before the signups here. And if I look at pull up here for the historic here for 2019, it's giving the actual in terms of what the margin went, and then kind of the forecast out here. What it would have been here, the forecast on last year, the end of last December. Now, if we look at it for now, kind of in current, we can see here for 11/16 right now here, the margin here is forecast to drop down here based off of the futures here early into the next calendar year. And so the green is basically, there's 25% chance above, or in this green band, 25% in the red, 50% chance kind of in this area. So you can see there's a good chance here we'll be below, this 950 margin here in the next year, according to, the forecast here based on futures market data that's been made available here. So that's something to keep in mind here. And just to kind of give an idea of how things would pay out here, if you go to dairymarkets.org, DMC here, I put in values here just saying we had 1,000 cow dairy here with the average production of that 24,000 pounds per year, just a little bit above the U.S. average. And just to go through, just say we insured the maximum here, 95% of the production, saying this is what the historic production is. It's kind of matching up with what the current production is. That's obviously not going to be the case for most, but it makes the example work through somewhat simpler. So we select basically the maximum coverage here. So we have 5 million pounds on Tier 1, and then we have 17.8 million pounds here on Tier 2 here for this 1,000 cow dairy. So in order to have this level of coverage here for the first 5 million pounds and $9.50 on the margin, and then $8 on the margin, we have an annual premium here of like $330,000, or about $1.44 per hundredweight there of milk. So if we were to look at this historically, how things paid out, you could see it was just here in 2012 and 2013 that we actually had net benefit here in terms of payout after our premium cost, and that in most of the years here we were, it was costing us to have that. But it did cover a huge loss in 2012 here in particular. But another case to look at it is, well, let's look at, just say we insured for the maximum here of the Tier 1, since that's subsidized the most. It has the cheapest premium there per pound, and then we just do the catastrophic down here, the $4 down here on to Tier 2. You can see the premium dropped from $330,000 some dollars down to just $7,600, and that's also reflected in the average premium per hundredweight there of just a little over 3 cents per hundredweight there. So, basically this shows that the Tier 1 is pretty good, and especially if you look at it in terms of the payout. Basically, there was only 1 year where it didn't pay out, and that was 2014. So, it seems like, the takeaway from this short exercise would be that you want to at least get in on the Tier 1 here, because I think you're leaving a lot of money on the table if you're not signed up for Tier 1 anyway, because of the price that's available, the subsidy that's on there. And if we look at it just for 2020 here, this here I'll show as well. So we have our $9.50 kind of range here, income over feed cost here. And if we look at the payment, it's over on the right axis over here. You can see we maximize the payment here, around the $4 per hundredweight here in May, and we'll probably have a little bit here in September as well, as I noted, maybe that 10 cents. So you see there is, a fair probability here of, having some kind of a margin below 950 here in these, through the remainder of the year here. If I look also at this map here, this kind of shows overall participation and everything for the 2020 dairy margin coverage program. Right now, for 2020, we had about 56% or 57% of all the production insured. A couple things to note by state here. You can see Wisconsin here had some of the highest coverage in terms of percentage, not as much as like Minnesota here or some of the states around it here, Indiana, but they had the highest payouts here, over 46 million. One of the reasons they can get that higher payment is, their average dairy cow is about 140 cows, versus over here in California where the average dairy size is about 1,250. So the Tier 1 is maximized a lot more over here in Wisconsin than, like, say, California. But that doesn't mean that each dairy can't benefit just as much in the sense in the absolute dollars. It's, because whether you have 5,000 head or 100 head or 200 head, you're still able to utilize that same 5 million pounds on the Tier 1 and benefit with the same dollar amount, even though it doesn't cover the same percentage of production that you have out there. Given the exercise we went through, I think it's clear where we probably have, most of the signups and the maximum here for the Tier 1, and we also have a lot of coverage here with the catastrophic here. There's, a little bit in Tier 1 down here at the catastrophic. I'm not sure why they would want to leave that money on the table. Hopefully some of the people that are in this area here are are listening, so they can say, I really should be trying to take advantage of the opportunity that is afforded right now. It's not a guarantee you're going to get a payout, but if you look at the return numbers over the months in recent years, this is a pretty good bet, being up at the 950 there with each year one. If we look at enrollments here for 2020, again, by states, it varies a fair bit. If you look at like Wyoming here, it's kind of interesting. Half the dairies are signed up, but basically we have about 96% of the production history enrolled in the program. If you look at California here, they have about just 50% of their production history enrolled, and just roughly around 46%. If you go to Idaho, they're about half of their operations, as well as about a little less than half of their production there. So there's a fair bit of variation here from state to state. And one thing that's interesting here as well is if we look at the signups here enrolled through 11/16, it's like just 18.43% overall. I just checked for today. They just released the numbers through the 23rd, and that's jumped up to 25.49%. But you can still see we're probably still quite a ways behind where we would need to be in terms of overall matching with where we were last year, which is kind of hard to imagine because with the uncertainty and the ups and downs this last year and also looking forward, you would think that a lot of producers would be ready to jump on the bandwagon if they haven't already. So I guess to just wrap up here, I guess, keep in mind, I guess, the decisions here are, participate with dairy margin coverage. One good thing is you can participate with both DMC as well as the livestock gross margin or the dairy revenue protection program, which Ryan's going to talk about next. And the great thing is, though, also just to keep in mind, you just can't have the livestock gross margin or the dairy revenue protection here on the same milk. But overall, I think in this environment with the prices going up and down, a risk management tool like dairy margin coverage is something you just can't afford to leave on the table and not take advantage of. With that, I'll turn it back over to Shannon. Thank you.
Yep. Thank you, Russ. Really appreciate it. Again, we're going to hold the questions to the end and handle it as a panel discussion.